Something unusual is happening across the precious metals market, and if you only look at the gold chart, you may miss the bigger story. Gold has surged toward the $4,600 area, silver has pushed toward $70, and behind this move is a development that goes far beyond ordinary bullion demand. The U.S. Treasury has just announced a major increase in its long-end liquidity support buybacks, at a moment when America's national debt has crossed the $40 trillion mark, and investors are becoming increasingly nervous about the direction of U.S. fiscal policy. As of August 21st, spot gold was trading near a 3-month high, with Reuters reporting a price around $4,562.86 per ounce, while U.S. gold futures reached roughly $4,620. Silver was even more aggressive, rising around 1.8% to approximately $69.31 per ounce. These are not small moves. They tell us that something in the macro environment is changing rapidly. And here is where this story becomes interesting. The Treasury is not simply watching the bond market from the sidelines. Treasury Secretary Scott Bessent announced an expansion of longer-dated Treasury buybacks, with the department saying the size of its liquidity support operations will increase by at least double beginning September 9th. Now, a Treasury buyback does not mean the United States is magically eliminating its debt. That distinction is extremely important. The government is buying certain outstanding securities while continuing to finance itself through new issuance. The immediate objective is to improve liquidity and help the functioning of the Treasury market, but markets do not only react to what policymakers say they are trying to accomplish, markets also react to what those actions imply. And the implication investors are debating right now is whether Washington is becoming increasingly sensitive to pressure in the long end of the bond market. That matters because Treasury yields sit at the center of the entire financial system. When long-term yields rise sharply, borrowing becomes more expensive across the economy. Mortgage rates can rise, corporate financing becomes more expensive, government interest costs become heavier, and when investors begin demanding higher compensation to hold long-duration government debt, the question becomes much bigger than one Treasury auction or one trading session. It becomes a question of confidence. That is why the $40 trillion debt milestone matters. The number itself does not automatically make gold bullish. Debt can rise while gold falls. In fact, higher Treasury yields can sometimes create a significant headwind for bullion because gold does not pay interest. But when fiscal concerns combine with a softer dollar, changing rate expectations, and intervention in the Treasury market, the equation becomes much more complicated. And that is exactly what we are seeing now. Reuters reported that the dollar weakened as investors reacted to the Treasury buyback announcement, while gold jumped and Bitcoin also gained sharply. The report also noted that the U.S. 30-year Treasury yield had recently reached its highest level since 2007 as U.S. debt moved above $40 trillion. So the question for gold and silver investors is no longer simply, is inflation coming? The bigger question is this: what happens to precious metals if investors begin to believe that controlling financial market stress requires increasingly aggressive management of the Treasury market? Because if that perception grows, gold is no longer just an inflation hedge in the traditional sense. It becomes a hedge against uncertainty surrounding government debt, interest costs, currencies, and the stability of the financial system itself. And silver could be even more explosive. At nearly $70 an ounce, silver is approaching a psychological level that could attract enormous attention from momentum traders and long-term investors alike. But the path from $69 to $70 is not the real story. The real story is whether silver can establish itself above that psychological threshold while gold remains near record territory. If it does, we could be looking at a completely different phase of the precious metals cycle. But there is also a major risk that investors need to understand before assuming that this rally can continue in a straight line. Because Treasury intervention can calm markets temporarily, but it does not automatically solve America's underlying fiscal problem. And if long-term yields begin rising again, the dollar stabilizes, or investors suddenly demand higher real yields, gold and silver could face a sharp reversal. So this is not a one-way bet. The next phase may depend on what happens in the bond market. And that is where the real battle for gold and silver is now taking place. The most important part of this story may not actually be happening in the gold market. It is happening in the Treasury market, because when the world's largest government bond market begins showing signs of stress, the consequences can spread across almost every major asset class. Stocks feel it, currencies feel it, mortgage rates feel it, and eventually precious metals feel it. Look at what happened this week. Long-term Treasury yields had moved toward levels that investors had not seen in years. The 30-year yield had climbed above 5%, creating concern about the cost of financing America's enormous debt load. Then the Treasury announced that it would at least double the maximum size of certain long-end buyback operations from $2 billion to at least $4 billion per operation, beginning September 9th. That announcement immediately changed the psychology of the market. Bond prices moved higher, yields initially moved lower, and gold jumped. Reuters reported that gold gained around 1% on Friday to approximately $4,562.86 per ounce, while silver climbed 1.8% to about $69.31. U.S. gold futures reached roughly $4,620. But here's the critical distinction. A treasury buyback is not the same thing as the Federal Reserve printing money and purchasing government bonds. These are different mechanisms. The Treasury is managing its outstanding debt and trying to improve liquidity in particular parts of the Treasury market. So when people immediately call this money printing, we need to be careful. That does not mean there is no connection to the dollar or precious metals. There absolutely is a market connection. The key question is what investors believe Treasury intervention means for future yields, government financing conditions, and fiscal policy. And right now, that uncertainty is extremely important. America's debt has now crossed the $40 trillion threshold. Reuters reports that Treasury Secretary Scott Bessent has indicated buybacks could potentially become even larger, while federal interest costs are approaching roughly $1.2 trillion for the fiscal year. Think about what that means. When debt becomes enormous, every percentage point change in borrowing costs becomes increasingly important. If yields remain elevated for long enough, refinancing existing debt becomes more expensive. That increases interest expenses, which can contribute to larger deficits, which can require more borrowing. This is where the market starts watching the feedback loop. More borrowing can mean more treasury supply. More supply can pressure yields. Higher yields increase financing costs. Higher financing costs can increase fiscal pressure. And greater fiscal pressure can make investors look for assets that aren't directly dependent on the government's ability to service its debt. That is one reason gold becomes so interesting. Gold has no coupon. It doesn't generate interest. Under normal circumstances, that can be a disadvantage when treasury yields are high. But if investors become more worried about the long-term purchasing power of currencies or the sustainability of fiscal policy, the absence of a government issuer can become an advantage. And silver adds another layer to this story. Silver isn't simply a monetary metal. It also has substantial industrial demand. That means its price can respond to both investment flows and expectations for economic activity. When monetary uncertainty pushes investors toward precious metals while industrial demand remains supportive, silver can potentially move much faster than gold. That is exactly why the move towards $70 deserves attention. At around $69.31, silver is no longer sitting comfortably below the psychological $70 threshold. It is knocking directly on the door, and markets love round numbers. If silver establishes itself above $70, the conversation can quickly shift from can silver reach $70 to how far can this move actually go? But there is another side to the story. The Treasury's intervention has not eliminated the bond market problem. In fact, Thursday's trading showed just how difficult this could be. After the initial rally in Treasury bonds, long-term yields moved higher again. MarketWatch reported that the 10-year yield rose to around 4.69%, while the 30-year yield moved above 5%. That tells us something important. The market may welcome Treasury buybacks, but investors are not automatically convinced that buybacks alone can solve America's underlying fiscal challenges. And that is why I believe the next major signal for gold and silver may come from the bond market rather than from the metals themselves. If Treasury yields fall while the dollar remains weak, that combination could provide another powerful tailwind for bullion. If yields rise sharply again, the situation becomes much more complicated because gold can rally on fiscal concerns, but it can also face pressure from rising real yields. And this is where the Federal Reserve enters the story. Right now, markets are also reassessing the probability of what the Fed does next. Reuters reported that traders were pricing roughly a 67% probability that the Fed would leave rates unchanged at the next meeting versus a 33% chance of a hike. So suddenly we have three forces colliding at the same time: Treasury intervention, a $40 trillion plus debt burden, and uncertainty over the future path of interest rates. That combination is creating a very different environment for precious metals than the simple inflation story many investors are used to hearing. And if this continues, gold may not be the only metal demanding attention, because silver is now approaching the level that could turn this rally from a gold-led move into a much broader precious metals breakout. The question is whether $70 becomes resistance or whether it becomes the launch pad for the next phase. And this is where the story gets even more interesting, because the first reaction to the Treasury announcement was not necessarily the most important reaction. The first reaction was simple. Treasury announces bigger buybacks, bond yields fall, the dollar weakens, gold jumps. But then something happened that the market could not ignore. The bond market started pushing pushing back. After the initial decline in long-term yields, Treasury yields moved higher again. The 10-year yield returned toward 4.69%, while the 30-year yield moved back above 5.2%. That matters because it suggests investors are not convinced that a larger buyback program is enough to solve the fundamental pressure building inside the long end of the Treasury market. And this may be the most important signal for gold and silver, because if Treasury buybacks can temporarily suppress yields but cannot permanently reverse the underlying trend, investors are going to keep asking the same question. What happens when the government has to borrow more money while investors simultaneously demand higher compensation for holding that debt? That is the problem underneath the headline. The United States now has more than $40 trillion in national debt. Reuters reports that the 30-year Treasury yield recently reached its highest level since 2007, while the Treasury has responded by expanding its long-term buyback operations. The scale of the debt is important, but the direction of interest costs may be even more important. Imagine the Treasury as a household with a massive mortgage. If the household has a small amount of debt, a higher interest rate is uncomfortable. But if the debt is enormous, even a relatively small increase in the average borrowing cost can have a much larger impact on the budget. That is the concern investors are beginning to focus on. And this is exactly where the so-called debasement trade enters the conversation. Now, we need to be precise here. Treasury buybacks are not the same thing as the Federal Reserve creating money to finance government spending. Calling the operation outright money printing would be inaccurate, but investors can still interpret aggressive efforts to control long-term borrowing costs as a sign that policymakers are becoming increasingly sensitive to higher yields. Reuters describes the current debate in exactly those terms. If Washington does not allow borrowing costs to rise freely, some investors worry that part of the adjustment could instead appear through a weaker dollar. And that is where gold becomes extremely interesting. Gold does not need the Federal Reserve to announce a new quantitative easing program for investors to become bullish. If the dollar weakens, gold becomes cheaper in foreign currency terms. If real yields decline, the opportunity cost of holding gold can fall. If fiscal uncertainty increases, investors can seek assets outside the traditional government debt system. Put those three forces together and you can understand why gold has moved so aggressively. Reuters reported spot gold around $4,562.86 on Friday, with U.S. gold futures reaching approximately $4,620. The metal was also on track for a third consecutive weekly gain, but silver may be sending an even louder signal. Silver climbed approximately 1.8% to around $69.31, bringing the metal directly toward the psychological $70 level. And this is where momentum can become self-reinforcing. When silver approaches a major round number, traders start watching it. When traders start watching it, volatility can increase. And when a market is already in a strong trend, a psychological breakout can attract even more attention. But we should not confuse attention with certainty. Silver does not have to break $70 simply because it is close. It could fail at that level. It could consolidate. It could experience a sharp correction. And if Treasury yields rise substantially while the dollar strengthens, precious metals could come under pressure. That is why the bond market remains the real battlefield. Gold and silver are telling us that investors are worried. Treasury yields are telling us that investors are still demanding compensation for those risks. And Treasury officials are telling us that they are willing to become more active in the market. Those three signals are now colliding. There is another factor making this even more complicated: inflation. Oil prices have remained elevated amid geopolitical tensions, creating another potential source of inflationary pressure. At the same time, the Federal Reserve has to balance inflation against economic growth and financial conditions. Recent reporting indicates that markets were assigning a roughly 67% probability to the Fed holding rates steady at its next meeting. So the Fed cannot simply respond to every increase in Treasury yields by cutting rates. If inflation remains stubborn, aggressive easing could create another problem. That leaves policymakers with a difficult balancing act: keep yields high enough to maintain confidence in the dollar and control inflation, or support financial conditions enough to prevent government borrowing costs from becoming increasingly difficult to manage. And precious metals are sitting directly in the middle of that debate. This is why I would not describe the current move as simply another gold rally. It is a market trying to price the relationship between debt, yields, the dollar, inflation, and monetary policy. And if that relationship continues shifting in favor of precious metals, the next question becomes much more aggressive. Can gold challenge its previous record high again? And can silver finally break decisively through $70? Because if those two levels fall, the psychology of the entire precious metals market could change. Now we reach the part of the story that matters most for precious metals investors. What happens next? Because gold and silver have already reacted to the Treasury announcement. The next move will depend on whether the market starts believing that this is the beginning of a broader shift in financial policy, or simply a temporary attempt to calm a stressed bond market. And there is a major difference between those two outcomes. The bullish case begins with the dollar. On Friday, the US dollar was under pressure as investors questioned whether Treasury's intervention could provide more than temporary relief to the bond market. Reuters reported that the dollar was heading toward a weekly decline, while investors remained concerned about America's growing debt burden. That matters because gold is priced in dollars. When the dollar weakens, gold can become more attractive to international buyers, but the relationship goes deeper than a simple currency calculation. A weaker dollar can also reinforce the perception that investors should diversify away from dollar-denominated assets. And that is precisely the environment in which gold tends to attract attention. Remember, gold does not need a financial crisis to rise. It can rise simply because investors believe the opportunity cost of owning it is becoming less attractive relative to the risks of holding other assets. If long-term Treasury yields remain unstable, if fiscal deficits remain large, and if the dollar continues weakening, gold has multiple potential sources of support. That is why the move toward $4,600 is so significant. Reuters reported spot gold around $4,562.86 on Friday, while U.S. gold futures reached approximately $4,620. The metal was also on track for a third straight weekly gain. But here is the key point. Gold has already made a major move. That means investors should not automatically assume that the next move will be another straight-line rally. Markets rarely move that way. After a powerful advance, profit-taking can appear. Traders who bought much earlier may decide to lock in gains. Momentum can slow. Technical resistance can become important. And if Treasury yields suddenly move higher again, gold could experience a sharp pullback even if the long-term story remains bullish. We have already seen evidence of this tension. Treasury's initial announcement pushed yields lower, but those gains did not fully hold. Reuters reported that the 30-year yield returned toward 5.25%, showing that investors remain skeptical about whether buybacks can address the deeper causes of rising long-term borrowing costs. This is extremely important, because if the Treasury has to keep increasing its intervention simply to prevent yields from rising, markets could eventually ask an uncomfortable question: is the government treating the symptom instead of the disease? The disease in this case is not simply a lack of liquidity. It is the combination of enormous debt, persistent deficits, inflation uncertainty, large Treasury issuance, and investor demands for higher long-term compensation. And no buyback program by itself can eliminate those forces. That brings us back to silver. Silver is now approaching $70 after rising about 1.8% on Friday to approximately $69.31. The $70 level matters because psychological numbers can become magnets for market attention, but I would watch what happens after $70 rather than simply whether silver touches it. A brief move above $70 followed by a reversal would tell us something completely different from a sustained breakout followed by several sessions of consolidation above $70. The second scenario would be much more significant. Why? Because it would suggest that the market is accepting higher prices rather than simply testing them. And if silver establishes itself above $70 while gold remains above the $4,500 area, the broader precious metals complex could attract even more momentum. But there is a second scenario that investors need to respect. Suppose the dollar suddenly rebounds. Suppose Treasury yields move sharply higher. Suppose the Federal Reserve remains more restrictive than markets expect. In that environment, gold and silver could both experience a correction. That would not necessarily destroy the long-term bullish thesis. It would simply remind us that precious metals are markets, not one-way elevators. There is also another variable that could complicate the picture: oil. Higher energy prices can create inflation pressure. Reuters reported that geopolitical tensions were contributing to elevated oil prices, creating another challenge for policymakers because persistent inflation can make aggressive monetary easing more difficult. So policymakers are potentially caught between two competing pressures. They want lower long-term borrowing costs, but they also need to prevent inflation expectations from becoming unanchored. They want financial markets to remain stable, but they cannot simply eliminate every risk that investors are demanding to be compensated for, and they want the dollar to remain trusted. But if markets begin interpreting policy intervention as a form of financial repression, confidence in the currency could become another variable. That is the real macro battle, and gold is sitting directly in the middle of it. If investors become increasingly concerned about fiscal sustainability, gold can benefit. If the dollar weakens, gold can benefit. If real yields fall, gold can benefit. If central banks continue diversifying their reserves toward gold, that provides another potential source of structural demand. Silver has an additional engine because of its industrial role. So the bullish setup is powerful, but the risk is equally clear. The Treasury can intervene, the Fed can change its policy expectations, the dollar can reverse, yields can rise, and precious metals can correct very quickly. That is why the next major signal I would watch is not another headline about gold. It is the relationship between the 10-year Treasury yield, the 30-year yield, the US dollar, and gold. If yields fall, the dollar remains weak and gold stays firm, the market may be telling us that the current rally has deeper foundations. If yields rise and gold refuses to fall, that would be even more interesting, because that would suggest investors are becoming less sensitive to the traditional relationship between yields and gold. And if that happens while silver breaks and holds above $70, the entire precious metals narrative could enter a new phase. The question then becomes much bigger than $70 silver. It becomes, how high can this cycle actually go? So where does this leave us? After everything we have discussed, I think the most important takeaway is that the current gold and silver rally cannot be understood by looking at precious metals in isolation. This is a story about the bond market. It is a story about the dollar. It is a story about the cost of servicing more than $40 trillion of US debt. And ultimately, it is a story about investor confidence. Gold has now moved toward the $4,600 area, with spot gold reaching around $4,562.86 and US gold futures touching approximately $4,620 on August 21st. Silver has climbed to around $69.31, putting the metal directly in front of the psychologically important $70 level. But the most interesting part is not simply how high prices have moved, it is how gold and silver are behaving while the bond market remains under pressure. Treasury's decision to increase long-term buybacks initially pushed yields lower and helped weaken the dollar, giving precious metals another powerful catalyst. But the relief has not been permanent. Long-term yields subsequently moved higher again, showing that investors remain concerned about the underlying fiscal and inflation picture. And that creates two very different scenarios from here. In the bullish scenario, Treasury intervention helps stabilize the bond market, long-term yields gradually decline, the dollar remains under pressure, and expectations for easier monetary policy strengthen. That would create an extremely supportive environment for gold. If gold can remain above the $4,500 area and eventually reclaim and hold the recent highs, the market could begin testing psychologically important levels above $4,600. But silver could be the more explosive story. Silver is already around $69, meaning $70 is no longer a distant target. It is immediately in front of the market. If silver breaks above $70 and, more importantly, holds above it rather than immediately reversing, momentum could accelerate. That does not mean that $100 silver is guaranteed. It means the market would have crossed an important psychological threshold, and traders would likely begin reassessing the next major resistance zones. And this is where I would be careful. A breakout does not automatically mean a straight-line rally. Silver is historically more volatile than gold. A move higher can be followed by an equally dramatic correction. If Treasury yields rise sharply, if the dollar strengthens, or if the Federal Reserve becomes more hawkish than markets expect, precious metals could quickly give back part of their gains. There is also the inflation problem. Higher oil prices and geopolitical tensions can keep inflation pressure elevated. That can make it more difficult for the Federal Reserve to ease policy aggressively. Reuters has highlighted the tension between inflation concerns, Treasury yields, and expectations for future Fed policy. So the market is trapped between two competing forces. On one side, enormous government debt and concerns about fiscal sustainability are supporting the demand for hard assets. On the other side, elevated yields and persistent inflation can create a headwind for metals. That is why the next few weeks could be extremely important. Watch the 10-year Treasury yield, watch the 30-year Treasury yield, watch the US dollar, and then watch how gold reacts. Because if yields rise and gold falls, the traditional relationship is still functioning. But if yields rise and gold refuses to break down, that would be a very different signal. It could indicate that investors are becoming more concerned about fiscal and currency risk than they are about the opportunity cost of holding a non-yielding asset. And if the opposite happens, yields fall, the dollar weakens, and gold remains above $4,500. The bullish argument becomes even stronger. Silver should be watched separately. The first question is $70. The second question is whether silver can consolidate above $70. And the third question is whether the gold to silver relationship begins shifting further in silver's favor. If all three happen together, precious metals momentum could become much stronger. But there is one thing I would not do. I would not assume that because gold and silver have reached these levels, they can only go higher. Markets punish certainty. The strongest rallies can experience violent corrections, and the strongest macro narratives can temporarily fail. The Treasury buyback program itself is not a magic solution to America's fiscal problems. Reuters reports that investors continue to question whether these measures can address the deeper issues surrounding debt, deficits, and long-term borrowing costs. And that brings us back to the original question. Is this simply another precious metals rally, or is the market beginning to price something much bigger? Right now, the evidence suggests that investors are increasingly paying attention to the relationship between U.S. debt, Treasury yields, the dollar, and precious metals. Gold near $4,600 and silver near $70 are the visible results. But the underlying story is happening inside the financial system. If fiscal concerns continue increasing, if the dollar remains vulnerable, and if long-term yields become increasingly difficult to control, gold and silver could remain major beneficiaries. If policymakers successfully stabilize the bond market while maintaining confidence in the dollar, the rally could slow or experience a significant correction. That is the battle we need to watch. So don't just watch the gold price. Watch the bond market, watch the dollar, watch the Fed, and watch what silver does around $70. Because the next major move in precious metals may not be determined by a gold headline. It may be determined by whether investors continue trusting the system behind the dollar. This is macro bullion. I am an independent analyst, and this analysis is for information and educational purposes only. Markets can move sharply in either direction, and past performance does not guarantee future results. Always do your own research and consider your own risk before making any financial decision. The real question now is simple. If $70 silver becomes support instead of resistance, and gold continues holding above $4,500, what happens when the market starts looking toward the next psychological levels? That is where this story gets really interesting.